Welcome to House Lux Estate, where we help you make the best decisions in your investment journey. Our mission is to provide you with the knowledge and insights you need to navigate the complex world of investments. Whether you're a seasoned investor or just starting out, we're here to guide you every step of the way. Today, we're diving into a topic that's crucial to your success: the 10 signs that you should not invest in an idea. Yes, you heard that right. Not all ideas are worthy of your hard-earned money. Some may seem promising on the surface, but upon closer examination, they reveal red flags that signal potential pitfalls. These signs range from lack of a clear business plan to legal issues that could jeopardize your investment. Investing requires careful consideration, so let's delve into these signs to help you avoid costly mistakes. Sign number 1, the absence of a clear business plan. Imagine setting off on a journey without a map or a destination in mind. Sounds risky, right? That's exactly what investing in a business without a clear plan looks like. A business plan is not just a document, it's a roadmap for success. It outlines the business's goals, strategies for achieving them, and the time frame for their achievement. It's a critical tool for managing a business and monitoring its progress. When a business lacks a clear plan, it's like a ship sailing without a compass. It suggests a lack of preparation, a lack of direction, and a lack of foresight. It's a red flag that the business may not have a well-thought-out strategy for achieving profitability. It's a sign that the business might not be a sound investment. A lack of a business plan can signal a lack of direction and foresight. The second sign to watch out for is overly optimistic projections. Now, there's nothing wrong with a dash of optimism. It's the fuel that powers innovation and risk-taking. But when optimism turns into overconfidence, that's when things can get tricky. Imagine a startup projecting it will capture 50% of the market share within its first year. That's not just ambitious, it's unrealistic. It's essential to remember that projections are just educated guesses, and overly optimistic ones can be misleading and dangerous for investors. They often indicate a lack of understanding of the market or an attempt to woo investors with inflated figures. Investors who buy into these projections may find themselves on the losing end when the company fails to deliver. In essence, overly optimistic projections can mask the real risks of the business and paint an inaccurate picture of its potential for success. While optimism is good, unrealistic expectations can lead to significant losses. Thirdly, high turnover of key personnel is a major red flag. Now, why is that? Well, imagine a ship with a constantly changing crew. It's difficult to maintain a steady course, isn't it? That's exactly how a business with a high turnover functions. The constant change within the team can lead to instability, affecting the overall performance of the business. Furthermore, a high turnover might indicate poor management. Employees often leave when they are unhappy with their work environment, and this dissatisfaction usually stems from the management's inability to effectively lead the team. In addition, the loss of key personnel can result in a loss of critical knowledge and skills that are vital to the business's operations. And the time and cost involved in training new employees can significantly impact the business's bottom line. So, before you invest, take a good look at the team. A stable team is an indicator of a healthy and well-managed business. Signs 4 and 5 are inadequate financial records and high debt levels. Now let's delve into why these two red flags are pivotal when considering an investment. Inadequate financial records are akin to navigating a ship without a compass. They're a clear indication of poor financial management, which can lead to a variety of problems down the line. It's essential for any business to maintain comprehensive, clear, and accurate financial records. This provides transparency, allowing potential investors to gain a comprehensive understanding of the venture's financial health. If a business fails to provide this, it could be hiding financial difficulties, which can significantly increase your risk as an investor. Moreover, financial records aren't just about past performance. They also provide a foundation for forecasting future financial performance. Without them, it's challenging to predict profitability, cash flow, and return on investment. Now let's shift our focus to the fifth sign: high debt levels. Debt isn't inherently bad. In fact, it can be a useful tool for growth when managed correctly. However, excessive debt is a different story. It can be a significant burden on a company's cash flow, potentially leading to insolvency. High debt levels can also limit a company's flexibility, making it harder for them to adapt to changes in the market or to seize new opportunities. Furthermore, a company with high debt levels may have to divert a significant portion of its profits to pay off its debts, leaving less money to invest back into the business or to distribute to shareholders. In conclusion, both inadequate financial records and high debt levels can significantly increase your risk as an investor. They could limit a company's growth potential, hinder its ability to adapt to market changes, and ultimately affect your return on investment. Therefore, it's crucial to thoroughly scrutinize a company's financial records and debt levels before deciding to invest. And remember, inadequate financial records and excessive debt can significantly increase your risk as an investor. Signs 6 and 7 are lack of market demand and poor pricing strategy. Market demand is the lifeblood of any business. It's the driving force that propels a product or service from conception to profitability. If there's no demand for what a company offers, it's much like a ship sailing without a destination. Even with the best crew and the most advanced equipment, without a destination, that ship is essentially lost at sea. In the investment world, this translates to a lack of profitability. Businesses need a strong market demand to thrive. If there's no demand, there's no sales. Without sales, there's no profit. And without profit, your investment is likely to sink. So, how do you gauge market demand? It's not as simple as asking people if they would buy a certain product or service. It requires thorough market research, understanding consumer needs and wants, and analyzing competition. It's about looking for signs of market saturation and identifying gaps that a business can fill. Now let's move on to the 7th sign, poor pricing strategy. Price is one of the most critical factors that influence consumer buying decisions. It's a delicate balance. Price too high and you risk alienating potential customers, price too low and you compromise profitability. A poor pricing strategy can be detrimental to a business. If the price doesn't reflect the value of the product or service, customers may feel cheated or undervalued. On the other hand, if the price is too low, the business may struggle to cover costs and turn a profit. An effective pricing strategy considers factors such as production costs, market conditions, competition, and perceived value. It's a strategic decision that requires careful consideration and constant review. So when considering an investment, pay close attention to the market demand for the product or service and the business's pricing strategy. These are key indicators of the potential success or failure of your investment. Without market demand and a solid pricing strategy, your investment may not yield the desired returns. Finally, signs 8, 9, and 10 are no unique selling proposition, inadequate management, and legal issues. Let's dive right in with sign 8, the absence of a unique selling proposition. Now, what exactly does this mean? Each business should have a unique selling proposition or USP. This is a factor or consideration presented by a seller as the reason that their product or service is different from and better than that of the competition. It's what sets a business apart from the rest. If an idea lacks this, it's like a ship without a compass, aimlessly floating in a vast sea of competition. Next up, sign 9, inadequate management. This is a critical factor. A company can have a great idea, but if it doesn't have the right people to execute it, the idea is as good as dead. Inadequate management can manifest in various ways: lack of experience, poor decision-making, lack of leadership skills, and so on. Remember, a team is only as strong as its weakest link. If the management is weak, the entire business structure is likely to crumble. Finally, we arrive at sign 10, legal issues. Investing in a business embroiled in legal issues is like stepping into a minefield. It's risky, unpredictable, and could blow up at any moment. Legal disputes can drain a company's resources, both financially and in terms of time and effort. They can also tarnish a company's reputation. So, if you see a company with a history of legal troubles or potential legal risks, it's best to proceed with caution. Now, these 3 signs are not just mere red flags. They could spell disaster for an investment. They could indicate a lack of competitive edge, poor leadership, and potential legal headaches. So when considering an investment, look out for these signs. Don't just focus on the potential profits. Look at the bigger picture. And remember, it's always better to be safe than sorry. These 3 signs could indicate a lack of competitive edge, poor leadership, and potential legal headaches. So there you have it, the 10 signs that an investment may not be a good idea. We've journeyed through the red flags, from the absence of a clear business plan, overly optimistic projections, and the high turnover of key personnel, to the more complex issues like inadequate financial records, high debt levels, lack of market demand, poor pricing strategy, and even legal issues. And let's not forget the importance of a unique selling proposition and competent management. Each of these signs is a warning bell, a nudge to reconsider, reevaluate, and perhaps redirect your investment elsewhere. Investing is more than just pouring money into an idea. It's about understanding the risks, assessing the rewards, and making choices that align with your financial goals. So keep these 10 signs in mind as you navigate your investment journey. Remember, investing is a journey and making informed decisions is key. Thank you for tuning in to House Lux Estate. Don't forget to subscribe for more insightful content.